Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this video I'm going to look at how you can improve your returns by not actually investing. So when I was reading Richer, Wiser, Happier by William Green, one of the really intriguing chapters was chapter 4, and that goes into detail about Jean-Marie Eveillard. And he actually credits his success for what he did not invest in. So let's get on with the video. So Jean-Marie Eveillard was born in 1940 during the Second World War in France, and he became an investment analyst in the 1960s in France. And his bosses actually gave him the normal stock picking process at the time, which was just to invest in larger companies in the index. But in 1968 he was posted to New York, and he actually met two French students who introduced him to the ideas of Ben Graham. He then read Security Analysis and The Intelligent Investor, and his view on investing was instantly transformed. But unfortunately his managers didn't actually believe in the ways of Ben Graham, so it wasn't until 1979, when he was actually aged 39, that he was able to start investing with his own philosophies. And this is when the company allowed him to become the manager of a small fund, but actually only had about $15 million in assets under management when it started. And Eveillard really bought into Ben Graham's idea of margin of safety, and he based all of his stock picks around finding the intrinsic value of the company and then buying them at a steep discount. So as I mentioned, he kind of credited a lot of this success with the things he was able to avoid. And one of the major kind of market bubbles in the 1980s actually came in Japan. And in the late 1980s, Japan had seen an incredible rise in value of equities and real estates. And this was down to a lot of different factors that had kind of come about from political and economic changes. And this allowed a huge bubble to form in the Japanese markets. And what's really incredible here is that in 1989, the Japanese markets actually represented 45% of the global market capitalization. And this was more than the US and the UK stock markets combined. So we'll just jump into Yahoo Finance and look at how overvalued the market had actually got at that point. So here we are looking at the Nikkei index, and we can see the peak there in December the 29th, 1989. And this actually peaked at 38,916. And 2.5 years later, by mid-1992, we'd seen a 60% drop to 15,910. And based on Eveillard's investing philosophy, he'd exited out of all the Japanese companies in 1988 because he just couldn't kind of find any value there within any of the companies. Everything had got so overpriced that he exited the market completely. And obviously, looking back in hindsight, this was a really wise decision. And over the next 20 years, the Nikkei would continue to fall, and it actually kind of hit rock bottom in 2009 in February. And it had dropped by that point to 7,568, which was 80% less than what it was back in 1989. And I'm sat here now in November 2021, and the market is still 25% below what it was in 1989. So if any of you think that really the stock market is only going one way, you just need to look to Japan to see that that really is not the case. We can have markets where it's not going to bounce back for 20 to 30 years, which is an incredible amount of time, and obviously that's going to destroy any returns you've got. So you really need to avoid that kind of thing where possible. And in the late 90s, irrational exuberance was really high in the markets in the US, particularly in the tech stocks. And this was a time of a huge amount of IPOs, everyone claiming to be an internet company. Companies were reaching valuations of hundreds of billions of dollars, even though they were making no earnings. Everyone was out there trying to do a new IPO for a different tech company, and the bubble was really building at that point. And during this whole time, Eveillard had managed to actually avoid investing in any tech stocks. But pressure was beginning to build from his investors, because obviously the thing is, when you're managing a fund, you need to be making returns. So they're seeing everyone else's returns kind of going up really high because they're heavily invested in tech stocks, but Eveillard completely stayed away from these. And this is what we see in the book. It's called To Lag is to Suffer. And I'll just read an excerpt from that now. So Eveillard's troubles began in 1997. By then he had an 18-year record of avoiding mishaps and beating the market. In his worst year in 1990, Sogen International had lost a paltry 1.3%. Along the way, his assets under management has soared to $6 billion US. Unexpectedly, the threat to his financial fortress came not from a market meltdown, but from a frenzy of speculation. So we can see here that the Nasdaq hit its record high of 5,048 on March the 10th, 2000. And you can see after that there's a really steep decline as all of the tech stocks basically dropped off a cliff. The drop continued to September 2002 when it bottomed out at 1,114, which is a drop of 78% in 2.5 years. And we can see here in this slide that it actually took over 15 years for the Nasdaq to kind of recover to the same level it hit at its high in 2000. So we can see here that it took till April the 23rd, 2015 to actually pass the same level that it had just done in March the 10th, 2000. And of course, there's a lot of winners that could have been picked along the way, but it's very difficult in that kind of sense to be buying into these tech stocks that were so overvalued. And this is when it pays to think of Warren Buffett's rule number one.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are.
And obviously, Phil Town named his whole business after this as well. And that's kind of how important this concept is to anyone who's investing. First, you need to make sure that you actually don't lose money. And there's a lot of focus that's always made on, oh yeah, let's pick the best stocks. But really, we need to be defensively minded. We need to actually, firstly, avoid picking the bad stocks. And almost by default, if we eliminate all of the worst stocks, then we're going to end up with a fairly decent chance of getting good returns. So now we've looked at a couple of the biggest market bubbles of all time, I thought what's a good idea is to actually go and see what are the signs that there is a market bubble. So we'll jump into this article here. So here we're just looking at an investing article which is actually from September the 21st this year, and it kind of gives you 5 different signs that you're in a stock market bubble. So we'll just jump down in this article to just kind of look through a few of these. So we can see here the first point is the stories capture the market's imagination, and this is kind of like goes back to mentioning the tech bubble in the 1990s. And obviously one of the compelling stories here was that the Dotcom Bubble has actually got the internet stocks are changing everything. So here we're looking at something that's kind of promising to transform the world, and that was actually true if you look back at it, but obviously the valuations got a bit out of hand compared to reality. And you can see here in this paragraph that the benefits of the internet eventually arrived, but not before effectively destroying hundreds of dot-com companies that had poor business models. And even some of the best companies that you will have seen in the last 20 years got caught up in this frenzy. If you look at Amazon, that's a kind of really good example of it. They dropped by a huge amount before they actually pulled back kind of around 10 years ago. And moving on to the second point, a sign of a bubble is that prices rise regardless of news. And we can see here that it mentions that in a bubble, every bit of information verifies the story of the stock, so the prices rise regardless of the news. So it goes on to say here that if a company hits earnings, the stock climbs. Even if it misses earnings estimates by a mile, the stock still climbs. There seems nothing that can actually stop the rise of this stock. And point number 3 here, that other asset prices are soaring as well. And often a market bubble is not just stocks that are soaring, so it can be other assets as well. So you might be looking at kind of real estate at the same time. It's like everything is climbing really high. And here the second paragraph mentions that you'd see different things skyrocketing. It mentions here collectibles and promoters trying to hype new assets by kind of mentioning how investable they are. So these assets are producing no cash flow, so you're kind of entirely reliant on the kind of idea of the greater fool. So that's the kind of concept that you're relying on finding someone who's going to pay more than you did for it. And obviously that's not really the way to go, or an easy way to find kind of valuations. And we're seeing it now through NFTs and a lot of different crypto. And like moving on to point 4, new traders are saying that old investors don't get it. So this is kind of a great example, and actually Phil Town uses this example a lot as well. When you're getting stock tips from your taxi driver, that's when you know that you must be in a market bubble, because these people have never taken any interest in the stock market before. And then you'll see here that the new breed of trader will often explain to you why Warren Buffett doesn't get the new paradigm and Buffett's old school. But I think the evidence kind of suggests otherwise, and obviously Buffett's managed to do it over kind of almost 60-70 years, which is incredible return. So you can't really argue against Warren Buffett just based on his track record alone. And moving on to the 5th point they mention here, so stock valuations are always in the top percentiles. And it mentions here that during the last phases of a stock bubble, the prices are all out of proportion to reality. And it's important to recognise that a price rise alone is not sufficient to say something's a bubble. A stock can rise by 100% and not be in a bubble if its underlying fundamentals have actually improved significantly. Or perhaps you could be looking at they started from a low valuation in the first place, for example, the bottom of the pandemic. And of course, then if you hit a solid bull run, then you're going to think that the actual figures are making this a market bubble. So you need to really be always looking into the underlying fundamentals of a stock. And I'll just leave you with one more thought from Jean-Marie Eveillard regarding his success. To the extent we've been successful over the decades, it's mostly due to what we did not own. We owned no Japanese stocks in the late 80s, we owned no tech stocks in the late 90s, and we didn't own any financial stocks to speak of between 2000 and 2008. So we can see here that by avoiding all the disastrous market bubbles, that actually this kind of cemented his success. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you haven't already. And you can click the notification bell to get notified when I'm releasing new videos. And let me know in the comments what you think about this kind of strategy. Is it something you follow? Or are you more based on trying to pick the winners? Always interested to know what you've got, so please leave that in the comments. And I recommend the next video you go and watch is my risk factors video, and you can kind of learn how to avoid these mistakes by checking that one out. So thanks for watching, and I'll see you in the next video. Cheers.